Today I want to talk to you about put option deltas, and hopefully by the end of this video you're going to be able to make rational decisions and turn this knowledge into profit trading stock options. Over here on this chart, on the x-axis I have the share price, and on the y-axis I have the delta ranging between 0 and -1. The reason why these are negative figures is because put options move exactly the opposite direction as to the share price. So if the share price goes up, then the put option value goes down. So what is the delta? The delta is basically used to measure the theoretical change in the value of option price given a change in the price of the underlying security. So for example, over here, the green line indicates that I'm at 50 delta. Now, just to make sure that you don't get confused, traders don't normally say that it's a minus 0.5 delta. It's just too wordy, so we just normally say 50 delta. So if the underlying security or share price goes up by $1, then we can expect the option price to change by 50 cents. The delta is also a great indicator of the probability of the underlying security price reaching the given strike price. So this bottom chart shows you the chart of the put option at expiration. So if you purchased a put option with the strike price of $50 and the share price goes down to, let's say, 42, then your trade breaks even. But if it continues going down, then this trade is profitable. So over here you can see that initially, when you purchase this put option, then you have to pay a certain amount of premium. So if the share price goes up, then obviously you will lose the money that you spent on the premium. So this is like an insurance policy. I have another video that talks about put options specifically, so I'm not going to go into more detail, but let's focus on the put option delta instead. So in this diagram, I wanted to show you what happens if the share price goes from 50 to 60 and you purchased a put option with the $50 strike price. Let's see what happens to the delta. As you can see, the share price moves up, and together with the share price, the delta S-curve also moves up. So now my original put option, which had a 50 delta, now only has a 19 delta. What does that mean in terms of probability? So originally, the option had a 50% probability, so it was at 50 delta. But now that the share price went up by $10, I have a significantly higher probability. So basically my delta is at 19, and if I convert that into probability, it means I have an 81% probability that the share price is going to remain above the strike price, in this instance above $50. On the bottom chart, we can also see what happens to the premium when the share price moves up. So you can see that the premium for this particular put option diminishes quite substantially. That's because the risk is much less that the share price is going to go below $50. So once again, initially we purchased a $50 put option and the share price moved up. So the put option that we purchased is now worth much less because we have a significantly higher probability that the share price will remain above $50. So let's take a look at how the put option prices work when the underlying stock price moves. As you can see, the put option price is also an S-curve. If the share price moves up a little bit, let's say by $4, then we can expect the put option price to diminish by a certain amount. And if the share price continues moving up, then the value of our put option continues diminishing. But the important thing to notice is that the change in the option price is dropping. So when we move from, let's say, 50 to 55, then we had this much change. But then as we continue moving up by $5 increments, then the put option value doesn't change by as much as originally. And that's because the delta curve, or in other words, the probability curve, is an S-curve. Therefore, the put option prices can also be indicated on an S-curve. Now, what happens if the share price goes down? It's exactly the same thing as when the share price goes up, except that in this case, the option prices are increasing. And initially, the increase is quite big, but then as the share price continues going down, that change in the option prices are diminishing. On this slide, I have a couple of examples, BHP and Coin. They have almost exactly the same price, 60.63 versus 60.50. And I took these screenshots on the 5th of April 2023. And as you can see, the deltas at $60 strike price for May are very similar, 0.44 and 0.41 or 44.41. But the key difference is that the IVR for Coin is at 131% versus 34% for BHP. And you will see why that is the most important metric that option traders use. So if we take a look at the probability of these two stock prices reaching $50, you can see that there is a massive difference. For BHP, you only have a 7 delta, or in other words, you have a 93% probability is not going to go down to $50 by expiration, which is 19th of May 2023. Meanwhile, for Coin, the delta is at 0.-25, or in other words, 25 delta. So that's a massive difference between these two stocks. So let's take a look at how that looks like on our delta curve. So you can see that we have two S-curves in here with very different sloping, and in a moment you will understand which one is indicating BHP and which one is indicating Coin. On the bottom we have the option prices, so we can take a look at both of them at the same time when we simulate what happens if the price goes from $50 to $60. As we can see, the delta for the dotted line moved from 50 to 25. For the continuous line, it moved from 50 to 0.07. Now, if we go back one slide, then we can see that the $50 strike price has a delta of 7 for BHP and 25 for Coin, which tells us that the continuous line is showing us the BHP, while the dotted line is showing us the delta movement of Coin. Now let's take a look at what happened to the option price. So if we go back one step, the option prices obviously diminish as share prices go up, but the drop of the option price is quite different. If you take a look at what happened, the BHP option price dropped significantly more in comparison to Coin. This is not in dollar terms. This is more in percentages or in ratios, because the two underlyings, the two companies, have very different volatility. Therefore, the option prices are very different. If we go back one slide, we can see that a $60 strike price is trading at $9 for Coin, while it's only trading at $2.25 for BHP. That's because the probability of movement, or the expected movement for BHP, is only 760, while for Coin it's 2420. So the higher the IVR is, the higher the option prices are. So when you trade options, don't just look at the option prices, but rather look at the IVR as well as the probability of success and the delta curve, which gives you the indication as to how much movement you can expect if the price moves a certain direction. So now we have a better understanding of how put option deltas work and how put option delta steepness is different depending on the volatility of the underlying. So now let's take a look at the various option strikes. So over here we have the delta curves of one particular stock with different strike prices. So the orange indicates a strike price of $60, the red indicates a strike price of $50, and the green indicates $40. The option prices are basically dependent on the underlying and the volatility and the overall market conditions. So we don't know, but it's not really relevant for this particular theoretical discussion. What's more important is to understand how the option prices move when you select different strike prices. So with the $40, $50, $60 strike prices, you can see that the delta curve is exactly the same, but it's shifted. Now, on the bottom chart, we have the probability of profit. So what I'm going to do is, instead of focusing on the delta this time, which we already discussed, I'm going to convert the delta to probability of profit. Basically, it could be a little bit easier to understand if we talk about probabilities. But the main takeaway is that you need to understand that deltas indicate the probability of profit. So the red dot is sitting at 50% probability because it has a 50 strike price, and currently the share price is at $50, while the orange dot indicates a roughly 80% probability because we are in the money by $10. The green one still has plenty of room to move. Our green strike is at 40. Currently, the share price is at 50, so we still have $10, or in other words, 20% movement before we reach the $40 strike price. So that has a, let's say, 20% probability. Once again, these probabilities and the deltas and the option prices are dependent on various other factors, but you just need to understand the theory behind it and how option prices and probabilities move as the share price moves. So let's simulate what happens if the share price goes up to $60. On the upper chart, we can see that the orange dot moved down quite substantially, more or less the same amount as the red dot, while the green dot didn't move much. So although all three of these options lost value because the share price moved from 50 to 60, the biggest loss took place where the strike price was at 60 or 50, while the smallest loss of value took place where the strike price was at 40. So if we take a look at the probability, then we can see a very similar trend. Originally, the orange dot was at 80, and now it's gone down to 50. We know that it's 50 because the orange dot indicates a $60 strike price and the current price is at $60. So that's got to be 50. So it's a 50-50 chance whether the price is going to go up or down from the $60 mark. The red dot went from 50 to roughly about 20, and the green dot went from just under 20 to less than to approximately 7%. So once again, if we focus on the 40 strike, if somebody purchased a $40 put option when the share price was at 50, then they had a roughly about 19% probability that the share price is going to go below $40. But if the share price goes to 60, then that probability drops to about 7%. So if we take a look at what happens when the share price goes all the way to 70, then we can see that the movement of the option prices are stabilizing for the green dot, while for the red dot it's slowing down, and eventually the orange dot is going to slow down as well because of the nature of the S-curve. And the same can be observed for the probability. The probability doesn't reach zero because there is always a chance that something terrible is going to happen to a particular stock and it will go below the given strike prices. So there is always a minimal residual probability for every put option and call option. So what happens if the share price goes down? Then we can see that the movement is exactly the same as when the share price goes up. So if we go back to the beginning where the share price was at $50 and you want to purchase a put option with the intention to make money, then what strike would you choose? It really depends on so many factors. So there is no black and white answer to this. But the key takeaway in here is that if you believe that the share price is going to go down, then you may purchase a put option, but you want to purchase a strike which gives you the greatest percentage increase. If you take a look at this green dot, it's right at the bottom of this steep slope. So that is what you would want to purchase, because if the share price goes from 50 to 30, then you're going to make significant profit on your investment. But if you purchased an in the money strike price, then you pay a lot more. So you pay significantly more for that option, but you are already $10 in the money, so you need to take away $10 from the put option price, and that's the actual extrinsic value that you pay for it. Personally, I'm an options trader and I normally sell options rather than purchase options. So if I have an assumption that the share price is going to go down, then I rather sell a call option instead of purchasing a put option, because I like to collect premium and enjoy the time decay. So hopefully this all made sense, and if you have any questions, then feel free to drop me a line, leave a comment, or reach out to me via my website tycoonitos.com, and I'll see you on the next video. Thank you for watching.